Hey traders, I wanted to do an interesting video for you today. It's not a win video. It's not about how we made $1 million overnight. It is focusing on the two trades that we have inside of our model portfolio right now that are stinking it up. These are our two worst trades that we have going on. What do you do with them? When you have a trade that doesn't work, how do you figure out where to fish or cut bait? How do you figure out where to adjust or simply take the loss and move on? So I want to show you our two worst trades, talk about why I think they have an opportunity, a potential to become a couple of our best trades. All right, let's go ahead and get into this. I think this is an interesting video because, again, it talks about our two absolute worst trades that are going on in our trading room. And of course, you know, we talk a lot, we hype our quote-unquote model portfolio quite a bit. At any given time, we have 20 to 30 positions going on. Some of them are interlocked or hedging one another. We have non-equity correlated in there. We have short, we have long positions, much like a hedge fund. And so the overall portfolio works together. We use the German word Gestalt, which in trading means that we're looking at the whole and the sum of the parts and what that equals, rather than the individual portions of your portfolio. We could have 30 positions on. And if 25 of them lose money today, but my net lick is up on the day, I'm happy. Because ultimately, at the end of the day, the way that we keep score of our success or failure as a trader is our net lick. You know, that's the bottom line, right? Is your account value going up or not? That's really the only thing at the end of the day that we care about. Win-loss ratios, all that kind of stuff. It doesn't really mean much, because it doesn't help us pay our bills. The only thing that helps us pay our bills is our net lick. But nevertheless, in a portfolio of 30 positions, you're always going to have something that's not working. And we got a couple right now that are, to say they're not working is a little bit of an understatement. And so I wanted to get into those, talk about those, use them as an example, and maybe talk about, you know, how do you approach a losing trade? Give you some tidbits on that. So we'll talk about that just in general, but we also want to get into talking about these specific examples that we have in our model portfolio. So I think one of the questions that we talk a lot about in our community, our trading community, is, you know, what is the potential to turn a losing trade into a winning trade? And how do you go about assessing that? How do you go about thinking about that? Well, one of the first things that we talk a lot about is this idea that how you set up your trading approach, money management we call it, can be more important than what you trade. We talk about this concept a lot, that you can make money in trades that you are wrong on. You could have a bullish stance or a bearish stance on a particular underlying, be wrong, and still end up making money. If you have really good money management skills, you are position sized correctly, you scale, you have dry powder on the sidelines to come in and adjust should need be. All that stuff's really important, right? And conversely, sometimes you can lose money on trades that you're right around. We see this all the time with new traders who are just buying options, buying a long call, buying a long put, and they're right on the directional basis, but they still lose money. So how you manage a trade, how you approach your trading can be more important than, you know, what it is that you're trading and what you think it's going to do. And hopefully you'll see that here in the two examples that I'm going to give you. These are two trades that aren't working for us, but I think that not only are we structured in them in a way that we can fix that, but it might also reap some pretty decent rewards for us. So we'll look at that in a second. But we talk about that as money management. You can call it scaling or position sizing or having dry powder. We put that all under the umbrella of money management. Aligning your expectation with your strategy is really important. That's an important lesson to learn in life. Generally speaking, when people are dissatisfied with their situation in life, it's because what they are experiencing versus what they were expecting are two different things. And even if what you are experiencing is bad, if your expectation meets that, you're actually pretty sanguine about the whole situation. You're actually pretty mellow about it. And so it is important to meet your expectations with what you actually are trying to do. We have both of these trades that I'm going to show you are hurting us directionally. So I'll just tell you right now, the trades that we're on are bonds and oil. And we're on the wrong side right now of both of those trades. On oil, we're short, and oil's been pushing up. On bonds, we are now long. It was a delta neutral trade. Now we've been assigned and we're in a long position, and bonds have been pushing down. So we're on the wrong directional side of both of these trades. However, there is a very, very heavy cash flow component to these trades. And sometimes I think maybe members of our community don't really get that. We use the analogy or the metaphor of a rental property. Let's say that you bought a $100,000 rental property, and that rental property would vacillate all over the place. Some months it would be worth 70 grand, and maybe somewhere it'd be worth 110 grand. But it would bounce around quite a bit, and it very likely that month in, month out, you might see your $100,000 rental property only be worth 70 grand. Right? Lots of valuation fluctuations there. But that $100,000 rental property was renting for $40,000 a year. And you understand, hey, I only really need to rent this darn thing out for maybe 2.5 years. And whatever the property is worth is gravy. Like, it's paid for, it's free and clear from the rent. And whatever it's worth is just icing on the cake, right? So both of these trades are in that situation. Both of them are not doing well for us directionally, but from a cash flow standpoint, they're amazing. And so you have to look at that. And there's a couple of ways to look at that. We talk about it as the crossover period. So, let's say, a very simple example. Let's say that you look at a trade that you're down $10,000 on, but it's bringing in $1,000 a week in income. That's pretty easy math, right? It's going to take you 10 weeks to cash flow that trade to the point that you can presumably get back to a break-even standpoint. Does that make sense? We look at those crossover points. Is it, measured in a few weeks, a few months, or in some cases it's a few years, right? If you start measuring your crossover point in years, it might be time to cut bait on that trade and move on. So that's one of the things that we look at. And we'll talk about that here, that crossover point, that break-even point in these two trades. The other thing that we talk about a lot is zero-based thinking, using zero-based thinking to make sure that the trade that we thought was amazing, we put some of our hard-earned money into it, and now here we are down the road a little bit, and we're wrong. It's not working. What do you do? Well, zero-based thinking is the concept of looking at a trade as though you were looking at it for the very first time. Looking at it with absolute fresh eyes. removing all of your preconceived biases about the trade, because what happens is we ingrain our biases when a trade that we are in, that we have real hard-earned money in, starts to move, right? If it moves in our favor, we increase our confidence bias in that trade. We confirm that we were right, and sometimes we hold on too long in that trade. And conversely, when we are wrong in a trade, we will talk ourselves into the fact that it's not real, right? Our initial bias is still right, and we'll sit there in a losing trade. So zero-based thinking is just looking at that trade with fresh eyes and saying, okay, I thought the stock was a good deal at $20, but now here we go, and today it's 12. Okay, let's forget that I bought some at 20 and I'm buried on this trade. Let's just look at it with fresh eyes today and say, hey, I've never traded this before. It's $12 a share. What do you think? Is it a good deal? And a lot of times we will say, geez, I really did think it was a good deal at 20. I think it's a steal at 12, right? Or a lot of times you say, the reason it's 12 right now instead of 20 is that more news has come out. It's negative news. Knowing what I know now, no, I would not enter this trade. And that's the signal for us to cut bait. That's the signal for us to take our loss and move on, okay? So these are all tools that we try to use when a trade's not working for us to make sure that we understand really where we're at in the trade. Does it make sense to continue it? Let's jump into my account and I'll show you these two trades. Alrighty, let's take a look at a couple of these trades. Let me move this out of the way here. So, generally speaking, our portfolio has done fairly well for us. You hopefully saw the video that I just put up last night for the last 3 weeks performance. It's been solid. It's been really good, but there's always something that is giving us a little consternation and a little bit of headache. And for us right now, it is two trades. It's oil, CL is oil, and ZN, which are the 10-year bonds. Okay, those are the two that are giving us the most consternation. So let's talk about these a little bit, what's going on, and why we are doing what we're doing with these trades. So oil, of course, oil has been on an absolute tear as of late. And my chart here might not pull up, but oil has been on a tear. We have been basically short oil, okay? So if you look at our position here, I have a couple of different positions in oil right now, but the one I wanted to focus on is this one right here. That's a short contract. So we're short oil. We have a short position in the futures contract, and then we're covering it right here with two puts. Now you say, how can you cover one contract with two puts? Well, one contract is a covered position, and it would be, just a normal like covered call or covered put trade. You have the other one, and it would swing us from a short position to a long position. So shouldn't take too much more buying power to do two instead of one. Also, of course, doubles our income potential on the trade. This particular setup right here, disregard those positions in oil. That's for our portfolio margin setup. We're replacing KRE with this trade right here. So our trade right here is really this one, okay? And obviously oil has pushed up. And so we're upside down on this trade. You say, well, $1,100 is not a big deal. Well, we're actually closer on our CL trade to being upside down by, let me see our number, $11,000, okay? We rolled this futures contract right here. So we're actually down a lot more than this $1,800 right here. I'm down about 11 grand. Okay, oil's pushed up. It's worth about $1,000 a point. And we're about 11 points away from where we started shorting oil, okay? So what do you do with this? Well, my stance on this is that we don't cut bait on this, that we continue to fish. And here's why. Here's some of the numbers on this trade. So with covering this trade out each week, you can see I'm going out about 4 days on the cover here. I brought in about $700 on that trade. We're looking to bring in roughly about $180 a day in cash flow, in income on this trade, okay? So if we could do that, and we're doing that quite successfully here, if we could do that, it would take us about 12 weeks so we're bringing in about we're down about 11,000 on the trade. We're bringing in about 900 a week in income on the trade. Our break-even point would be about 12 weeks out, okay? Which is not bad. However, I would also calculate that we have about $10,000 of capital gains potential in this trade. Every point move in the CL is worth roughly $1,000. I think we've got about 10 points of downside. You look technically at oil back to November, December of last year. That's where the top was, in most recent top in oil. We're there once again, and we're bouncing off of it. So I think from a technical standpoint, we're good. So my point here is I think we've got $10,000 of capital gains potential in this trade. We're bringing in $900 a week in income. Yeah, it doesn't look really great right now, but I think that it will be a potentially solid trade for us, okay? So that's kind of the analysis there. Now the bonds are actually worse. So bonds, we're actually, well, they're actually better than what they show. We're actually not down 15,000 on the bonds. We've probably cash flowed this by $3,000 or $4,000 as we have traded this. So I'm calculating that I'm probably down actually about 12,000 on the trade. But of course, bonds, in this case, we're long 9 contracts of the 10-year notes. And of course, bonds have just continued to push down and down and down as interest rates have come up, right? So it's the same situation here. You look at this and you say, man, we have not been this low on bonds since 2007. That's how far back you have to go. I'm a big reversion to the mean trader. What goes up must come down. What goes down must come up. And I do feel like interest rates are going to come back up. Now, there's a lot of upside in that. I would say that there's probably as much as $9,000 of upside potential in these bonds. We're at 108.06, and our cost basis is about 109.25. So we're not far off from our cost basis. It's just a very leveraged trade, and any little move at all exacerbates your P&L by quite a bit. But you can see that we've covered it now. We've, again, gone out a week here, brought in about $1,700 of income. We're shooting for $1,500 a week of income. Now, if we could cash flow this at $1,500 a week for 8 weeks, that puts us back to our break even. That's not counting any potential capital gains that we have here. So again, we love the metaphor of a rental property, $100,000 property. Here's the examples of this. In the CL trade, I've got $14,000 in the trade. In the ZN trade, I've got $20,000 in the trade. So let's just add some zeros to this. Let's say that on the CL trade, instead of 14,000, it's 140,000. And instead of 900 a week in income, let's say it's 9,000 a week in income. Would you be interested in buying a rental property that was a $140,000 rental property that paid you a weekly, not monthly, weekly rent of $9,000 a week? I think most people, and I would tell you, look, with full disclosure, this rental property fluctuates all over the place in value. It's all over the place value-wise. But you're going to bring in $9,000 a week in income on a $140,000 property. Are you interested in that property? Most people would say yes. That's what we have right here. So that gives you hopefully a little bit of insight into, number one, 2 of our trades that are just stinking it up right now. Number 2, how we approach managing those. And maybe number 3, some information in terms of how you can analyze your losing trades and decide, hey, is this something that I should fish or cut bait on? I hope that's a help for you guys. Stay tuned to this video. Check back in 12 weeks. I'll be happy to let you know how our trades are going, if we're still in them, if we're still cash flowing them, where we're at on our P&L. But yeah, stay with me on them. Let me know. Love to engage you guys in conversations on that. If you are interested in being a part of our trading room, we'd love to have you. You can go to tradelivewithus.com and join up and be part of our trading community. Best online trading community out there. I really think that you're going to find opportunities here that you don't see at other places. And I think our results speak for themselves. You can try to be a naysayer as much as you want and sit on your couch with your bag of Doritos, but at the end of the day, our results speak for themselves. And at some point, you got to get in the game. But anyway, if you want to come trade with us, we'd love to have you. TradeLiveWithUs.com. If you are looking for more of a passive investing program that only takes 5 minutes a day, that is trouncing the stock market, just beating up the stock market, you can go to tryatmforfree.com. It's a fantastic program. We scalp every Tuesday and Thursday and try to get 500 to $1,000. Made $1,000 last Thursday. Made like $100 the previous Tuesday. So you never know what you're going to get with scalping, but there's a real true opportunity. You can put $1,000 in your day, in your pocket, in a day, in a morning. We usually do it within a couple hours. So love to have you scalp with us as well. If you just want to ask some questions, you can engage me through this website right here, askyourtradingquestions.com. And if you need to contact me, you can do that going to scottstewartcontacts.com. All my contacts are there for you guys. So appreciate you guys. As always, hope you are having a good trading week, a good start to your trading week. We got off to a little bit of a slow start here today, this morning, but ended up over $1,000 on the day, which is, that's good. That's good. We'll take it. So hopefully you guys are having a good week. We'll talk to you soon.